Hey, we're with the commodity report today. It is just me today. Sam might be able to join us in a little bit, but just kind of wanted to keep you guys updated on what's been going on in the markets lately. And there's a bunch of stuff to go over. I've got charts, I've got slides. We're ready to go. All the way from Bitcoin. We'll cover a bit of trend following today. We're also going to cover the commodities market, obviously, and also, the market bottom I called out the other week, on Friday, not last Friday, but the Friday before that. I said I think the market possibly bottomed. Looks like that could be true. We'll see. That more will be revealed with time. This could just be just a rally that's kind of coming into play, from oversold levels, too many shorts, whatever it is. So we'll see what happens over time, but that's how trading goes. It's a weight of the evidence approach, and we'll see where we end up. So starting out with slide one, we're looking at here is the year-to-date performance for all the commodities, futures, and so on. So this is the entire futures market, at least in the United States. There's a lot more things listed out there if you want to go outside of the United States, but these are the majors, the ones that everybody should know about. Starting out with natural gas, up 35% year to date. That is one hell of a move so far. It's been choppy, it's been messy. Every single time people get a pullback in natural gas, they feel like it's the end of the world. Natural gas is coming back. Are you still long it? You still think it can go up more? Um, this is how you understand these things. And something we're going to work on. My buddy Mark mentioned maybe I should make something on setting stop losses like a pro. And so, what the number one rule of doing this is understanding the risk to your portfolio, and then on top of it, the volatility of each position. So, if we're looking at natural gas and we go, okay, this thing could go up. I mean, literally, it's done moves of 100% in a couple months. Like, it's one of the most volatile assets in history. Because it's the most volatile asset in history, then we also have to understand where we need to put our stop loss. Our stop loss can be 20, 25, 30%. That's how wide a stop loss can be in something like natural gas if you want to ride a trend like this. If you're looking to move 5% natural gas, sure, you don't need a stop loss that's that wide. But if you're looking to ride a trend in natural gas, and within the normal volatility levels of it, and you're trying to catch those 102%, or sorry, 100, 200, 300% moves, you've got to understand that the volatility of each position is very large. So the volatility of natural gas is very wide. So you need a very wide trailing stop, just to give it room to dance. That's important. It needs to be able to jump around and move around and do whatever it needs to do, and then keep you inside of that trend, so you're able to move the upside and make those outsized returns. So that's why we always talk about very small positions. For example, you have $100,000 portfolio, you have natural gas, and you have a stop of, let's say, 30%. Maybe that's only a few grand in your portfolio. That's how you have to think of it, like trading like a professional. A professional will never go into a situation knowing that one trade creates a bunch of risk in their portfolio. For example, if I take my entire $100,000, let's say I put it into natural gas, and then it drops down, 30%. I've lost $30,000 and 30% of my portfolio in one trade. That's ridiculous. You don't ever want to do that. The most you ever want to risk is 2, maybe 3% of your portfolio. I think that's even pretty large, but you want to keep that risk small so you can hang on to these trades, number one, and that one trade doesn't wipe you out. You're not going to get everything right. That's important to think about as a trader. Next up is copper. Copper's up 26% year to date. That is one heck of a move for copper. Copper has been moving nicely all year long. I've got some great slides to talk about that. So as we talk about those slides, man, we'll talk about copper, seeing that move, what's going to continue to happen. But I still like copper here. Still long it. Still think it's got a lot further to go. I think a lot of people are going to look at it and go, well, it's up near resistance and it's doing this. Look, if it breaks out of that zone, that's when you want to own more of it. Right now, we're kind of chopping around. To me, I think we're in an all clear zone. For me, what that means is we're above all of the closes for the monthly closing charts, weekly closing charts. Like, so we're basically above those zones. So as long as we're above those zones, I really like copper. I think it can move to 7, maybe even $8. These things move. Commodities move. They're not boring assets that don't do anything. When they move, they really move up and sometimes down. So once again, understand the volatility of each position. This is copper. Somebody asked the other week, which is a great topic, which was, if I'm trading copper, the HG contract, that, how you have to put a really tight stop if you have any type of portfolio that's under, let's say, $1 million, because these contracts are over $130,000 each. And what I said is, number one is, yes, if you have a huge fund or something, or you're trading for yourself and you have a large portfolio, sure, you can trade things like HG. But there's MHG, which is the micro copper contract, which is much smaller. So once again, if you're going to trade futures, look at these smaller contracts out there. Look at the ETF. CPER is the copper ETF. A lot of people don't know about that one. That one's already hit a new high actually before copper futures. I think this could continue. So once again, it's continue to find these areas, continue to find these zones. Look at the metals and mining sector. Whatever you have to do to kind of figure out where you want to be and how you want to be positioned in this market. And if anybody has questions, feel free to jump in. I know I always say do that at the end, but I am just by myself today. So if you guys want to jump in, feel free to. And then next up, silver is very significant here. The DAX is Germany and Europe. That's very significant. So up 14%, silver's up 14%, gold's up 13%. And then we're talking about the futures contract, not the spot. This is all very significant, and it just looks like a rally in metals, a rally in metals and mining, and all of these things are kind of continue to come into play. What we haven't really seen yet is anything from crude oil. Crude oil took a little bit of a bounce. The positioning actually looks great for a positioning unwind, so I do think we will see a situation where crude oil starts to really take a leap and then move higher. But once again, we're not seeing that in the signals yet. I think crude oil is just stuck in a range right now, might go back to the top of the range around $75 to $80. And then we'll see what it does there. If it breaks out past 80, I would say it can absolutely go a lot further. So you guys have seen this chart a million times. This is the dollar. And once again, the dollar is always the most significant thing I'm always going to come to as a trader. It's the first thing I'm going to look at every single day. It's the first thing I'm probably going to show you guys. I'm going to show you these types of charts until you guys get sick of them, because the dollar is significant. It is the world's reserve currency. It's the most significant thing out there to understand what's going on, and whether it's stocks, commodities, whatever it is. Use the United States dollar. It will help you out as a macro trader. So as you're seeing here in this chart, basically I'm showing the cycles of the dollar. And the new cycle that we're seeing right now is probably a weak dollar cycle. And I've been talking about this for a while, but really what I'm trying to highlight here is we want to see that get under 100 and close under 100, and then really get under 99, start to be decisive at those levels. What we've seen from the dollar is that it just goes back into the range over and over again. And so right now it's back in the box. I like it back in the box. I think that's a good situation for stocks, commodities, whatever it is in the box makes sense. But what I really do think is going to happen at some point this year is we're going to start to see those closes under 99. I think we'll start to head lower. I think the dollar will start to look more similarly to bonds over a long-term period of time, where we saw bonds just continue to break down time after time, basically after 2020. I think the dollar is going to start to look very similar to that. But once again, we need to see it in the price. I can speculate all I want, I can think all I want, but the price action is the most important thing. So getting below that 99 level, seeing us cross that decisively, I would say it's a good time to start looking at all of these other areas that we've been talking about. And I still think that that's as simple as it gets. Just continue to look at all of these other areas. We talked about commodities, we talked about gold miners, talking about silver, talking about even energy is starting to shape up quite a bit. The leading sector this year so far of the spider sectors up 8%. But if we look at this chart, we're looking at what is really up a lot. And people who follow my channel, you guys know we've been long these since January. Things like Poland, China. We were long China last year actually, but we added with KWeb and other things this year. Where we have South America and exposure. We have Germany. I mean, you name it. There's a lot of things in there right now because these all look great. If you look at Poland, year to date, 34%. You're looking at Spain, 24%. Italy's up 20%. This is where the outperformance is. And as everybody's looking at the United States, I mean, even over the last month, this is 1 month versus the S&P 500. It's massively outperforming the S&P 500. So if you look at these charts and you see these trailing 12-month charts, you're seeing that these are all just going straight up as of recently. And you saw the United States, if you put the United States on top of that, it started to go straight down as these went straight up. And that's really as the dollar started coming down pretty heavily. And the biggest driver of the underperformance in the S&P 500 is the Mag 7. So the Mag 7 just kind of fell off of a cliff this year. If you look at it relative to the S&P 500, that's the bottom chart in green. You'll see that it started to roll over at the end of 2024, and then it really started to break down in February. Now we kind of have an island bottom with a nice gap out. Will this continue? I'm not sure. I personally think the United States market bottomed, but I still think the outperformance is in the other areas. It doesn't mean you can't buy some of these things and make some money. If you're a good stock picker, go ahead. But I try to find the relative strength wherever it is, whether it's commodities, bonds, stocks, currencies, cryptocurrency, whatever it is. That's what I'm trying to find because I'm trying to outperform the market. And I'm not seeing the relative strength really strong enough to say, hey, the Mag 7's good here. But once again, if you are looking for a buy opportunity to buy some of these names, I would say that that's probably here. Not my style, but for you guys who are looking for United States names only and so on, especially in the big tech names, probably a good time to start looking at the Mag 7 again. And this chart here is another one that I always kind of go to, which is my bull bear indicator. Very old setup chart that I've been using for a long time. And basically, we're just looking at stocks above the 200-day moving average on the top indicator. That's the black one with the blue and red lines. Below that in the middle, I'm just explaining all because it's a little confusing of a chart. The New York advanced decline line is in red, meaning stocks advancing versus stocks that are declining. And then below that is the S&P 500 in black. And on the bottom is percent of stocks above the 50-day moving average. And basically in between the red and blue lines, I'm looking at more of a neutral setup. So the bottom one is a shorter term indicator, and the top one is a longer term trend indicator. And we're seeing that percent of stocks above 200-day was just in that neutral zone. To me, that's not so worrisome just yet. And the same with the other one on the bottom, is just kind of stuck in this neutral zone. So I'm not too worried about this market just yet. But if we start to really close below that red line, I would be more worried about this market. But I do think today, if we stay strong here, if we hold up, we're going to get above 50% of stocks above that 200-day moving average. So I think today's significant. If we see a breath thrust recently, if we continue to get higher and get above these levels and get the percent of stocks above the 200-day moving average above 50%, I would say all systems go for more upside in the S&P 500, but I still think there's other areas that we want to pay attention to. You guys have seen this chart a million times at this point, and it's another one that I'm just beating to death because it's important. Once again, it's another significant thing that we all need to be paying attention to in this market, which is gold compared to the S&P 500. That doesn't mean that I'm looking at it and going, hey, buy gold today. It's up, keep following the trend. Once again, we're long gold. We like it. But would I buy it today? Probably not. Do I think there's possibly more upside? Sure, there is possibly more upside. But right now, I'm just kind of looking at it and going, okay, this chart is a ratio chart. And this is just telling me that gold is outperforming the S&P 500. And usually when this happens, we get into all of these zones that aren't we get into these zones where the S&P is underperforming for many years. So look back to 2000. The S&P 500 basically underperformed until 2011. I mean, that's a long time. So I'm not saying that's exactly happening today. I'm not sure how long this lasts, but I'm saying for right now, we are underperforming the S&P 500 for sure. And you want to be into gold, precious metals, the energy sector, whatever it is that's making money, international stocks. The goal here is to make money. And so this one, Sam and I have talked about this a bunch of times, which is the commodity cycle. And somehow those arrows moved back a little bit. No, they're in the right spot. Okay, that was just me. But if we're looking at gold, copper, and oil, you're seeing the way this cycle works. And I just brought this up on All Star Charts this morning on their morning show. Something I wanted to bring to you guys, though, as well, which you got gold, you got copper, you got oil. As gold starts to move, which is where these vertical blue lines are on here, they're all marking new 52-week highs for gold. You'll see most of the time these are kind of going two different directions. Gold makes a new 52-week high, and then copper bottoms. Slightly after that, oil bottoms. You see that kind of again and again and again as gold hits a new 52-week high. There's a liquidity event. What that means is when everybody is selling something, because you basically have a situation that the market's crashing, there's margin calls everywhere, these big funds, they start to get hit, they need liquidity. So what do? Well, they sell everything. It's not about, hey, we're in an inflationary environment now, hey, we're in this environment now. It's a let's get out of everything because we need to raise as much cash as possible immediately. So everything sells off in that, even though gold was still the best performer that year out of everything, basically. Gold got sold off at that point. Copper obviously got sold off heavily. Oil got sold off heavily. And then moving forward, you see once again, gold hits its 52-week high. Copper kind of bottoms. Oil kind of bottoms shortly after that. Once again, moving forward, you see gold hit a new 52-week high. And then a little bit later, you see that massive run that happened in 2020. So gold hit a new 52-week high last year. Copper is hitting a new 52-week high right now as we speak. I think oil is going to bottom out pretty soon. Once again, don't just go buying oil because it's cheap or low right now. We don't know how low oil can go. And if we get into a deflationary shock type of situation, that'll end up with oil quite a bit lower. So I do think that this idea here is that we need to continue to sit on our hands on oil until we really get a close above 80. We have a reversal trade on right now, looking for the top end of the range around 75 or $80. And so once we hit 75 or $80, I'd say, okay, let's see if it breaks out. Let's see if it can hold that breakout. And then we'll go from there. So then one of the most significant charts I keep bringing up is this gold and silver chart. If we look at gold to the US dollar, you're seeing this massive outperformance compared to silver. And then silver looks like it's ready for the catch-up trade of a century. If you look at this situation that's happened over and over again, it's gold starts to perform, and then silver slowly tries to catch up, and then it explodes higher. I think we have another explosive move in silver. I'm not sure exactly where it all ends up. The moves could be smaller than they were in the past. I'm not sure exactly how this is going to go. But I do think we could see silver at the very least go back to 50 and at the most hit 100 over the next year and a half time. I do think right now, we talked about it having a situation with gold and silver where we wanted to own call options. We've been talking about this for the last couple of years. We bought call options throughout last year. We have new call options this year. So far, those are doing very, very well. I think they'll continue. But I think that, you have to really look at the mining space. You have to look at the silver miners. You have to just go through all of these and really get an understanding of where you want to be and how you want to be positioned in this market. Personally, to me, I think there's a lot of good things about this market at the moment. I think the S&P 500 is a place you don't want to be, and you want to continue to look around at things like whether it's copper miners, and let me get a watermark on here for you guys. Whether it's copper miners, metals and mining, gold miners, silver miners. There's a million things you want to buy, and I think you want to continue to try to avoid the S&P 500. This is COPEX. It finally started to move. Everybody was kind of worried about it because you had copper basically hitting those new 52-week highs, and then you had COPEX, which is the Copper Miners ETF, just kind of sit around very flat. Now it's finally moving. Today it's making a new 100-day high. I do think that this probably has a lot more upside to go. Then if we look at TLT, which is treasury bonds, the 20 plus year treasury bonds, you're basically seeing this massive sell-off that's happened since 2020. We broke down. We had a little rally in 2021 for a minute. Then we broke down all over again. And every time it's tried to move higher, it's just kind of rolled back over again. Recently, it has started going up again. And even in an environment where people have been running away from treasury bonds over and over again, we're starting to see people kind of move into them. They are kind of outperforming the S&P 500 this year so far. I don't know if that's going to last, though. I do think the inflationary environment that we're seeing is probably here to stay. And because of that, I think we can continue to see more downside in TLT treasury bonds. I think the short end's a safe bet, though. If you are a futures trader, you do have access to those 2-year futures, the euro dollar futures, whatever it is. I think at that point you can buy those things and see how far you can go to the upside in those if the Fed continues to lower rates. But I think the long end of the curve, I don't want to be long this at the moment. It would really have to break above 100 and really start to sustain above 100 for me to get bullish on it once again, which is totally fine with me to miss out on this move until we get to 100. Sometimes you just got to really sit on your hands and go, okay, well, maybe we're going to hit that at some point. And I don't mind being late to a trade. It's not the end of the world. But if we look at GDXJ, we're kind of seeing the same setup over and over again in the miners, which is it's making new 52-week highs here. We're going to probably start to catch up to gold pretty soon. I think this thing's going to take out that $60, $70 high. We have some calls from last year actually that are still on the books that have done very, very well, but I'm still looking for those to target around 70. So looking for a target around 70 by August, and then looking for silver to possibly hit 50 by August. I think that's what, the move is going to be this year. So yeah, one last thing before I get out of here. I want to talk about this post here. Jim post. Why do you think COPEX is so weak relative to copper? Yeah, I did just go over that, Jim. So Jim asked, why do you think COPEX is so weak relative to copper? And the reason why is, one, markets are always fighting the last war. When things are selling off, everybody's kind of selling everything off, and especially in the stocks. And sometimes you don't know why, and sometimes it doesn't show up in the commodity. That's happened many times to me. Because I trade both of these things. I trade the futures and I trade the stocks. So looking at COPEX, though, I think it is going to catch up. I think there's nothing wrong with sitting on your hands for a little bit and just kind of waiting for these signals to come in those individual names that you want. But COPEX is hitting a new 100-day high, at least 20-week high. That's the way I weigh it out. I'd like to see it close there this week, and then I'd say, hey, it's time to start getting long these copper miners. For now, I think it's not a bad idea to start looking for your favorite one, setting buy stops, or buying if you're people who like to buy low. I want some momentum behind my moves, so I'm going to sit on my hands a little bit, ride the copper trade that we're in, and just wait for those to kind of catch up. So real quick before we leave, I posted this post. I will post it in the show notes. But it's a brutal truth about trend following, and I think that this is what you guys all kind of ask about: is hey, how exactly do you do this? And if you go through this entire thing, you'll get an understanding of, hey, this is what a back test looks like. And a real back test, not like a let's make this look pretty back test. This is a gritty back test showing you the drawdowns, the compounded annual growth rate, which is amazing if you are a trend follower and you can really handle it, but also telling you the risk. Here's the drawdowns. Here's how you handle these things, and understanding that no trader's really right all the time. And so your idea of being right all the time has to go out the window, and your idea of making money has to come into play, because there's a difference between being right and making money. Everybody, when they start trading, thinks I just got to be right all the time and then I'm gonna be the richest trader in the world. Really, it's a keep your losers small, let your winners run. This is said over and over again in every single trading book, but nobody thinks that that's actually the secret. But really, that is the secret. That is the edge. And if you can do that, you'll make money in markets. And the one thing I try to include in a lot of these is real trades. So this is Mulvaney Capital. This goes back a long period of time. Very long-term trend follower, has been doing this for many years as public returns, and they look phenomenal. But the point of showing you guys this isn't to say it looks phenomenal. It's to say, hey, you see a losing year here. You see a losing year here. Look at some of these months; they're pretty nasty. Some of the months are really great. You have a 30% month here. You're going to see that type of chop in your trading portfolio over time. It's just going to happen. I mean, look, it's 2024. He had a 20% down month here in 2024. He ended the year up 82%. 2023, he killed everybody. There was nobody who had an 89% return. Sorry, in 2022. There's nobody who had an 89% return in 2022. So, he just has a great strategy that works very well in all different types of environments. But at the same time, there is drawdowns, there is risk, but he's outperforming the market massively. And that's something that I want people to really understand is you got to figure out a way to let those lumpy returns happen. Understand that sometimes, that your best months are going to be only a few months out of the year. 2024, he had the first 2 months of 2024 were ridiculous. And then the rest of the year, very flat, up and down, a lot of down right there. And that's very normal. That's the other thing that you'll see over and over again in your portfolio is that a lot of traders make their money in the last couple months of the year and the first few months of the year. There's nothing wrong with that. That's something that's going to happen. It's based on seasonality, seasonal patterns. It's called the best 6 months strategy, created by Yale Hirsch, and that's November till April. Sometimes the summers are just full of chop and annoying, and there isn't much to do. But as trend traders, at least for me, I can speak for myself, I'm always very focused on how I'm positioned. If I can position myself well as a trader, I'm happy to, deal with drawdowns, deal with risk. It's kind of like last year is we're positioning in gold, silver. They have great buy signals. We're holding those all year long. Were they the best trades all year long? No, there's plenty of choppy periods of time, and then they exploded. Same with cocoa. It has you get a buy signal in cocoa and then chops around. Think of 2020 as probably the best example I had. October 2020, we started getting all of these signals. Basically, if you go back through my returns, if anybody wants to ask me, feel free to write me on Twitter or YouTube. I'll send you the post with the returns from 2020. And what happened is March 2020, we made a return, a good return. And then throughout those other months, basically the entire summer, spring, summer, all the way up till October, We didn't make anything. It was just chopping around, extremely annoying. It was a rough period of time. And so basically, October happens, we start to get buy signals over and over again, whether it was lumber, starting to short bonds, financials. Bitcoin was in a buy signal. And then November happens and everything explodes higher that we were long already because we were just taking the signals as they come. And then we had our best 2 months of the year ever. So we've never had 2 months that have outperformed those two back-to-back months in 2020, which were over 50% on one of them. I think one was just under 50%. So, you just want to be positioned properly. You want to continue to take the right trades as they come. It's like we talked about with the COPX to copper, basically copper miners ETF to copper futures. You want to just be positioned as they come. Copper's long. I want to stay long copper. And then if we look over to the copper miners, they're getting long. They're getting close to buy signals. Take them as they come. That's the best way you can do to be positioned for what's next. All right, guys. Hope you guys had a great Monday. We'll be live with Kashop on Friday for the Holy Macro Show. And we'll see you guys soon.